If you do not want to be part of this recording, you may turn off your video and you could just still stick around and just listen. Let's see what else. Okay, so please do remain on mute throughout this presentation so that the background noise won't interrupt our presenter. We do encourage you to place your questions in the chat room. Our presenter has scheduled her presentation to pause along her presentation throughout the slides for those of you who have questions. If you are going to take notes, feel free to do so. A recording will be available of this presentation towards, I believe, by next week. Also, we encourage you to stick around to complete a course evaluation once our presenter leaves. I will put a link in the chat room for you to complete a course evaluation, giving us your feedback regarding our presentation today. Today is May 13. It is Thursday. It is 10:04. And today's presentation is how to boost your retirement savings in your 50s and your 60s. We have our presenter today, Ms. Denise Ridley Davis. She is an independent insurance agent, insurance license. She does have her website, her contact information there, so I will provide you that towards in the chat. In the meantime, I do want to welcome Ms. Denise whenever you're ready.
Okay, well, I'm very happy to present this information, and hopefully you will all learn something new and be able to use it in your real life situation. Let me tell you a little bit more about myself. I retired from the health field as a physician in 2000. And that was when my son had some very challenging experiences for himself and for us. And I decided to return to work after dealing with some of those issues. But I decided not to continue in medicine, and I became a financial advisor in 2006. In 2013, I also obtained my certified financial planning certification. So I'm also a CFP. So that's my background. And I would like to now continue with some statistics. The average retirement age now is between 62 and 64, men at the higher age. But as you know, with all the circumstances that are happening, quite a few people are continuing to work beyond 65, beyond 70. And after spending 40 to 50 years working with increased longevity, people are living 20 to 30 more years in retirement, and they want to live as comfortably as they can. And most people prefer to maintain their lifestyle, or they want to have a better, more enjoyable experience. So let's talk about what most people are doing for their retirement. The majority of Americans, 90%, have their retirement savings in an IRA, 401k, or they're receiving a pension plan, or another name for it is a deferred compensation plan on the right. Tied into that, there are certain IRS rules that state that with these type of accounts, primarily the IRA 401k, you are required to leave it in beyond age 59 and a half because it was set up for retirement. They want you to leave it there for a prolonged period of time. Otherwise, you face a 10% penalty if you take the money out before 59 and a half. In addition, the money that you set aside for your retirement has not been taxed. So you are going to face in California 9% state tax and a federal tax, potentially average 25%. We know that federal state tax varies. So I imagine that most of you are familiar with that if you have any of these type of plans. This rule does not apply to pension plans though. You pay income tax based on whatever is paid out to you on a monthly basis. So now I'm going to talk a little bit about what you can do if you have one of these employer-related plans. You can decide to save more and put more away in your employer plan. Most plans have, at least in the past, have had what's called an employer match. Oftentimes it was 3%, 6%. If you put in $1,000, and that was less than what your match was, then they would match that amount and add another $1,000. Also, if you're over age 50, you can contribute additional amounts to your retirement plan. Another area where you can contribute is to a Roth 401k, and I'll go into the details of that shortly. With a regular 401k, you can contribute up to 19,500, which is deferring your salary. If you make $100,000, you could put up to 19,500 into that plan. And if you were over 50, $26,000 is the maximum. And your employer could contribute in addition to that. Now, when you think about a Roth 401k, you may know that there is no tax on what grows in that 401k when you take the money out, later in life during your retirement. There is a personal Roth 401k that you can do separately, and I'll address that when we talk about personal savings, but you cannot put in as much as you can. At the workplace is a greater amount, as I just noted. And whatever you put into that Roth 401k, that amount is taxed in that year. Now, are there any questions at this point before I continue? I want to make sure everyone understands what a
Yes.
Roth 401k is.
Yes, Dr. Davis. There is a question in the chat. It's from Elsie Gura. Her question is if this presentation will work for those who
Elise.
are in their 70s.
Elise.
Elise, my apologies. Elise.
Right? Yes, as long as you're working, it has to be earned income. So you need to earn income as a business owner. If you're working as, you could be an employee of your own business if you have a 401k. So, and if you set it up so that it allows for a Roth 401k option. So
Denise,
this would have to be arranged, and you would have to check with your employer, because not every employer allows the Roth 401k, but it has to be earned income that you're contributing.
Denise, my apologies. I had put in the question even before you started your presentation. And what I meant was, will your discussion apply to those who are in their 70s and no longer working?
Okay, so I answered that. Correct? Okay. All right. Okay. Oh, let's see. I'm sorry. Slide. Okay, so continuing, let me go. All right, so. Okay, so some of the personal savings options with regard to protecting your retirement and your estate is for you to review your permanent cash value life insurance, because many people are not aware that life insurance evolves. Just like you may have a cell phone, The cell phone you had 10 years ago may not meet your needs today. The life insurance policy you set up 20 years ago, 30 years ago may not meet your needs today. Maybe a low death benefit that would not cover your desired plan. So it's good to review your permanent cash value life insurance. And I bring this up with regard to retirement savings because life insurance has an application in your retirement years. So with permanent cash value life insurance, you can potentially eliminate or decrease the monthly premium if you're in good health, or if you have some health issues, you may qualify. And if you have cash value that you can transfer to a new policy, that even with health issues may be a better situation for you with regard to your long-term plan. Also, the newer policies, many of them have long-term care coverage. If you don't have long-term care coverage needs for at-home care, or if you have to go in a nursing home, you may have to go and use your retirement funds. So a policy can protect that asset, and you can leave it for your heirs rather than use it spending it on long-term care. So with the life insurance, it can also be used for retirement income at a later date. Personal savings in a CD or low interest rate savings account. It's recommended that you have an emergency fund set up that'll last at least 6 to 12 months. And some people may want to have it last for even longer period of time. The main thing is that accessibility. You can obtain those funds without paying a penalty or a price, and it's readily available. One way of handling this for retirement is to put those low earning long-term CDs in an account that doesn't risk losing, because that's why most people set up CDs in the bank. They don't want to lose their money. They want safety. You can have tax deferred growth with that, and you take advantage of the rule of 72. Has anyone heard of the rule of 72 when it comes to interest rates? Well, let's talk about that. If you have an interest rate of 1%, for example, if you divide that into the number 72, it tells you how many years it takes for your money to double. If you have $10,000, it would become $20,000 72 years from now. If you had an interest rate of 5%, it would become $20,000 in 14 years, and would take 29 years before it would be 40,000. But if it were an interest rate of 10%, your money would double to 20,000 in 7 years, and 14 years it would be 40. So this is referring to the compounded interest rate. Simple interest rate is different, where you just add 70%, for example, 10% to whatever you started with, used based on the original amount of 10,000. Is that clear? Well, no questions as we go along. All right. Let's talk about debt repayment. And this is important. And I bring this up because if you have significant debt, it limits how much you can set aside to save. All right. So the goal is to pay off debt and pay off credit cards. And whatever money you have stop using toward payment of your credit card or debt, that additional money is then directed towards savings. That's a key point. You pay off the debt, use the extra money to pay off whatever else, and then you can put that towards savings. I want to talk about a few credit card repayment strategies. You pay off the highest interest rate card first, and then you use that payment amount to pay an extra payment amount to pay off the next highest interest rate. That's one strategy. The other strategy is to pay off the smallest balance first. And always, always pay more than the minimum required monthly payment. Other considerations are consolidating your credit card balance and transferring it to an account or a bank or institution that has a lower interest rate. For example, if you transfer $10,000 to a different uh, credit card company, then, for example, they have 3% balance transfer fee, and you do not pay any interest on your repayment schedule until 6 months, most of the time 12 months, oftentimes 18 months. You're not paying any interest, which makes you able to pay off that debt significantly faster. And the goal is to try to pay it off by the end of that term of interest-free payments, so that when that higher 20, 30% interest rate comes back into effect, you've made significant inroads into your credit card balance. Another option for homeowners is to take out a low interest home equity loan, pay off the credit card balance, because the interest rates on home loans tend to be much, much lower than credit card. And the purpose of all of this is to have more money to set aside for your employer related plan, for your personal savings plan for your retirement. And one extra benefit is that home equity loan interest rate may be deductible. So even though I'm talking about other areas other than the savings, these come together and are strategies to help you boost your retirement, because the money you save in those interest payments on credit cards, they are going to be able to be put aside to your work-related or your personal savings for your retirement. However, um, the different strategies come together to help you. Some of the unpredictable costs in retirement: hospital costs, healthcare costs. Usually, most people have health insurance coverage, but there may be costs that are not covered. And some people delay their retirement exactly for that reason. They want to maintain their work-related health insurance until they can get on Medicare or for other reasons. Long-term care. Long-term care is not a coverage benefit through Medicare. And a lot of people may not be aware of that. There's some insurance plans that cover some parts of it, but we cannot think of Medicare as a means of coverage for long-term care, where we can't help ourselves, we can't go to the bathroom by ourselves, we can't feed ourselves. Even if it's at home, that can be a cost that can drain our retirement. or if you had set aside money for your inheritance. Taxes. Taxes are unpredictable. So we just have to do the best we can to have whatever we can set aside for our retirement, because with the situation now, especially after the pandemic and uncertainties, you know, you can see that the government is contributing a considerable amount to improve the lifestyle and the economy of so many people. Inflation. I mentioned inflation earlier. Well, actually, I should emphasize this a little bit more. Someone who has money in a CD, if that is earning less than 1%, and if inflation is 2 or 3 or 4%, that basically means that that person is losing money. Because if that one, for example, $100,000 of your funds are in a savings account, that means that if it stays at that doubling within 72 years, when you may not even be around, you know, even if you think about how much something costs today or 20 years ago, you know that even the purchase of a home, buying a phone, a record, all of those things have increased in price. So you would need more than that $100,000 to cover what you paid for 10 or 20 years ago. So if your money is losing its value, it really is something you need to take into consideration when you are in a low interest rate circumstance or account. And that is tied into the interest rate there as well. Went back. So I did address Medicare and how limited it is in terms of the needs that tend to occur when we are elderly. Most people have at-home care. 80% of the population tends to be taken care of by a family member or caregiver in their home. But if they do end up in a nursing home, which is out of our control many times, then that cost could double and be even more. Amount is hmm. I just saw that I was muted. Well, no one told me earlier.
You just muted for a quick second. I'm not sure what happened there.
Oh, okay, thank you. So how far back did that happen? Should I go back?
I didn't. This part right here is right when I noticed that you were muted and you weren't talking anymore. It was less than 30 seconds.
Oh, good. All right, so I'll just repeat what I said with regard to this slide. Okay, thank you. I guess my mouse, I should turn it off because it's probably slipping around on the screen. Okay. All right. Oh, I mentioned that long-term care is not really a benefit of Medicare. Okay. And there are some specific plans that have some Medicare long-term coverage, but that's not a common situation. People who are taken care of by their family members or by caregivers, the cost for in-home care, if someone is unable to feed themselves, transfer, go to the bathroom by themselves, can range around $4,000 to $5,000 per month, and even doubled for nursing home care. And in addition, if someone is taking care of their family member, that means they're out of the workforce. They're not contributing to Social Security, and that impacts their retirement years as well. Okay, so I basically summarized most of this here. And sorry about that. Okay. Okay. All right, so let's talk about tax-free retirement strategies in summary. I spoke about the Roth IRA, and when we get to the question and answers, if there's some questions about that or the Roth 401k, you can let me know. Roth IRA conversion you may not be familiar with, but basically, if you have a 401k, the majority of people convert that to an IRA, and that takes it out of the control or the limited options that you have within the employer plan. So once it's out of the 401k, you can make more wide range decisions in how you want to save for your retirement. So once it's in an IRA, you can convert some of those funds to a Roth. And it's not a good idea to convert, let's say, $300,000 into a Roth all at once, because remember, the 401k or IRA, they have not been taxed. And as soon as they are converted or distributed or you need it for whatever, then it's taxed at that income tax rate for the year. So what's the advantage of doing a Roth IRA conversion? You pay taxes, at least it's recommended that you pay taxes on a small amount being converted on an annual basis. This way, we speak about being taxed on the seed rather than on the tree. Tax on a small amount, let's say $3,000, were converted in a year, and you're in the 30% bracket, you're paying $900, 30%. I'm sorry, $3,000, yeah, $900 that year versus 30,000 converted at one time. You would be paying considerably more taxes depending on your tax bracket. So this is a way to have tax-free income, basically in your 70s, 80s going forward, or if you don't even use it, you can pass it on tax-free to your heirs. So that is another consideration for tax-free income for yourself or for beyond. Life insurance retirement strategy is more complicated, and basically it's something to consider on an individual basis, because now life insurance can be used with the cash value growth within a permanent life insurance policy to be used to achieve tax-free retirement income. And that can also be accomplished by the method that I mentioned earlier of exchanging into a new insurance policy where your goal is to have tax-free income come from that plan. Life insurance has changed considerably, and even during the pandemic, we've had some changes. Even higher amounts of life insurance can be obtained without going through the usual paramedic exam, blood and urine exam. And this is something that can be established for the individual. They can establish for their children. They can establish it for their grandchildren, because now whatever you have in that policy as cash value can be used for, in addition to retirement, it can be used to pay for weddings. It can be used for business expansion or to start a new business. And it can be used for you. It can be used for a child, a grandchild. It's basically up to you. So the main focus for this being brought up would be for retirement, but there's a lot of flexibility with regard to that because, as you know, things change, products change, companies are bringing forth many different options over time. And I went over the Roth IRA conversion, if we have any questions about that. And let's see, it's 10:34 now. So I will be wrapping up shortly and then open for questions. So even though I brought up the Roth IRA conversion, I want to caution that it depends on your situation. You have to check in with your advisor, your accountant, to see if it makes sense for you. And just go run through this slide quickly because I want to emphasize, how important this is to take into consideration that it's taxed. The converted portion is taxed in the year of transfer, and it allows for tax-free withdrawals in the future. You are no longer required to take distributions after age 72 if it is a Roth, not, well, I mentioned earlier, it's different for the Roth 401k versus the Roth IRA. So you don't have to take money out of a Roth IRA. Tax-free inheritance for your heirs, and basically you need to consider what your tax bracket would be. That's why it's important to consult with a financial specialist and your accountant if this is a consideration or if it makes sense for you. Okay. All right. Can you, this slide is telling you that if you have Roth, that is money that is not related to your taxes, so it would not impact Social Security benefits. As you may be aware that the higher your income during the time you're receiving Social Security, some of your Social Security benefits may be taxed at 50% or up to 85% if you are a high income earner. So that's mainly the benefits that are taxed at those higher rates if you have additional income coming to you. Now, that may be considered a blessing if you have the higher income, but that's just the way the system is. And it also does not affect your Part B premiums. Many of you may not be at that age where you even think about the Medicare Part B premiums, but you pay higher premiums if you are have a higher income overall. Okay, so we discussed the CDs and the impact it had on inflation and the rule of 72 and long-term care coverage with the benefits of having permanent life insurance cash value. Now, this particular side is not related to retirement savings, but I always like to share this information because it is so relevant to majority of people. If you have a home that you own, I recommend in California, especially, a living trust, because this way your assets, your home is passed on to whomever you designate, and it does not have to go through the courts to face additional court costs as well as attorney fees. And this can delay and complicate your situation for your relatives and your survivors. In addition, if you have health issues and you have business or home owned investment property, you want to have a power of attorney in case you're not capable of handling your circumstances and designate who would be responsible to handle these circumstances and make life changing decisions for you. So that usually is done at the time of setting up a living trust. And some people are reluctant to do that because they don't want to face their mortality, and they delay and delay, or they think that it is so expensive, but it is well worth it in terms of the cost that can be presented to the family members in the case of probate. So if this is important to you, at least I've made you aware. Some people, it may not be important to them at all. Whatever happens, happens. That's the attitude of many people. And I just want to inform you because so many situations I've encountered, where people are not prepared. Just another side point is that if you have a retirement account or you have an annuity and you name the beneficiaries, you don't necessarily need a living trust. And if you have minor children, then a will is recommended for that. And some grandparents do take care of minor children, or if they have small estates, a will is indicated. Another area to consider is final expense plan for burial arrangements, just to ease the transition for the remaining family members. And they have plans now where they will call burial services and arrange for the funeral homes and negotiate prices for you. So it would be less burdensome for the family member. So I wanted to include that because these are things that tend to come up in our later years and 50s, 60s, retirement years. And it is important. Planning is so important from my point of view. So I would like you to set a specific date to review your financial plan, review your insurance policies, set a date to set up a living trust if it is applicable to you, and set a date to set up your final expenses and get it done. So at this point, here's the summary. And since it's in front of you, we can tackle whichever questions you have come up related to any of these topics that I've gone over. Okay. So Hema, do you have any questions or do you want to unmute?
Let's see. Does anybody have any? I don't see any questions in the chat at this time, Dr. Davis.
Okay, all right. Is
I
there
did see Mr.
anyone who
Bailey
wants to
mute.
go on mute and come up? Everything has been clear or complicated?
Clear, but still complicated. I'm one of those, this is Nicole speaking. So I'm one who's, who took time out of working and was so young, I didn't start investing in my savings plans. And then coming out, I do more of either part-time work or consultant. So it's hard to start doing it for yourself, to save for yourself without that personal.
Well,
So
at least if you are working part-time, you can set up a Roth IRA for yourself. And in addition, a life insurance policy is another way to leverage because you're putting in smaller amounts to get a larger benefit in the long run. So those are things you could do on your own, even if you're not employed.
thank you. That helps. Thank you.
Mhm.
This is David. I have some older friends, and they said that sometimes that they were made to take money out of their accounts when they got 70. But I saw something that said that you didn't have to take out a minimum something of 72. Does those two things, are those two things the same?
Okay, the IRA and the 401k and also the Roth 401k, those are guided by IRS rules, and those are retirement plans that you don't pay any taxes on, and until retirement after 70, after age 70 actually, is when you would have to start taking money out, because that's the designated age that they set up as to when you need to start taking money out, since you haven't been paying any taxes. Now we want our taxes now that you turned 70 and a half. But in the last year, it was changed to age 72. So you would be required to start taking money out and paying taxes at age 72. So that the 70 and a half was well established for many years. Now it's changed to age 72, and that's called required minimum distributions, RMD. So if you have an IRA, every year money has to come out of it. But that does not apply to a Roth IRA that you set up as a personal account, but it would apply to a Roth 401k. You'd have to start taking the money out at age 72, and you don't pay taxes on that one. Okay, so I think that answered your question, Mr. Bailey.
Yes.
Dr. Davis,
Okay.
there's another question in the chat. What tools can we use to help our retirement for those who have high student loans?
Okay. Well, I can't answer that other than to say, if you're having trouble, figuring out how to pay it off, you may need to find a specialist who can give you some guidelines. But the bottom line is, whatever program is out there that assists people with student loans, they're specialists for that. Find out the best way to do that, because once you do that, then you can set aside money, additional money. But if you're working, if at all possible, you're contributing along the way to your employer plan, or if you are in a position to have a personal Roth IRA, those are things you do along as you go along. You should always save while you're paying off debt, because it sets you too far behind. And you start small if that's the only option you have. But you know, in terms of long-term savings, you can be more risky when you are younger. But if you're close to retirement, you may want to be more conservative with a portion of your money. So younger people with student debt may want to take more risks, so they're more likely to get a higher rate of return, as I showed in that rule of 72. Is there another aspect to that question? And find out.
I
Mm,
like to say, I used to listen to a guy named Dave Ramsey riding home, and he was on the radio for years. When I used to ride home, he'd come home at the time that I was coming home, and he helped a lot of people pay off their student loan debt. So I didn't have that student loan debt, so I really didn't pay that much attention to it. But he even had, I think, some of the people come on, So, but he's on like one of those I forget the 24-hour radio stations now. But him, if you wanted to like look up Dave Ramsey, he has like programs to like help people pay off debt.
Mm-hmm. Yeah. Well, that, like I said, there are people specialize in that area. Yeah, and there are different methods and approaches to that.
Thank you. Okay, here's another question. How do you open a 401k account or Roth IRA? Where do you go? Do you go to a bank or would you go to a website with the IRS?
Oh, well, I'll take one by one. A 401k is an employer-related account. And it could be a large employer and it could be an individual employer who has it could be a husband and wife, for example. They have what's called solo 401k for business owners. So it can it can be done. Usually, they're specialists who work on these type of plans. A lot of the investment companies out there, American funds, etc., they can be contacted directly. But if you have financial advisor, then you could work with the advisor for that. A Roth IRA, a lot of these type of accounts are set up by a financial advisor. Someone could go to a bank, they could go online to open up a Roth IRA. It's very straightforward. You contribute on a monthly basis. That's the best way to invest because you take advantage of the ups and downs and you can buy more when the market is down. So there are many different avenues for setting that up personally. But the other ones, as I mentioned, are through your employer. Or if you are the employer. Any other
Okay.
questions?
Thank you, Dr. Davis. Anybody else have any questions?
And also remember that you can speak directly and unmute yourself if you would like to ask the question verbally.
Princetta, do you have any questions or comments? Tamara, Cynthia, you may unmute yourself. Or any comments, thoughts, please. Now is the time. We still have 10 minutes.
Thank you. It was very helpful.
Okay. Well, that's my information. If you have at some point, some question comes up that you didn't think of, you can always contact me by phone or email. And if you need a referral for some particular situation, living trusts are done by attorneys or paralegals. If cost is an issue, I do referrals as well. So here's my contact information.
Thank you, Dr. Davis. I'll go ahead and put that in the chat real quick.
Okay, well, I hope that some of this information gave you some guidance. I hope it wasn't too complicated. And if you, as I said, just let me know, email me if you have a question or call me.
Thank you, Dr. Davis.
Is that it?
Thank you.
Oh, you're
Thank
very
you.
welcome.
Thank
All
you
right,
very
then.
much.
You're very welcome. Bye.
Bye. Did you put?
Emma's going to place the information for those of you who. Emma, you there? Oh, there she is.
I'm here. I'm sorry. So, I had a staff member come in.
So we'd appreciate the course evaluation, and you can place the information